All right, guys, let's start. So now we are doing your lesson number 3 of your chapter number 1, right? So lesson number 3 of chapter number 1 is about your yield curve shapes, right? Normal shape, inverted shape, flat shape, hump shape, right? This is in continuation with what we learned in lesson number 1 and lesson number 2, right? Lesson number 1 is was about your term structure of interest rate. Lesson number 2 about your zero coupon yield, spot rates, etc. Now lesson number 3 is about yield curve shapes, normal, inverted, flat, humped, etc. Okay, so let's go. Now, when we talk about your what determines the shape of the yield curve, right? What determines the shape of the yield curve, right? Expectations and risk premiums, right? The shape of the yield curve reflects how interest rates vary across different maturities. Two fundamental forces influencing the curve are expectation of future interest rates and risk premiums demanded by investors. We have expectation of future short-term rates. According to pure expectation hypothesis, long-term interest rates are determined by market expectation of future short-term rates. Given by this formula, if investors expect short-term rates to rise, long-term yields tend to be higher, producing an upward sloping yield curve. Conversely, expectation of declining rates may lead to an inverted yield curve. Risk premiums, liquidity premiums, which we have, uh, investor typically demand additional compensation for holding your long-term bonds due to your interest rate uncertainty, price volatility of long-duration bond, lower liquidity in longer maturities. This compensation is known as liquidity premium, which generally causes long-term yields to exceed your short-term rates. So again, what's in this slide? Basically, two forces are named as driver of curve shape, expectation of future short-term rates, and your risk premiums. Terms which are defined here are yield curves. Yield curves are what? A plot of different rate against maturity for one issuer and one instrument type at one point in time. Maturity is basically the time remaining until the loan is repaid. Pure expectation hypothesis, the theory that long rates are built only from expected future short rates. Liquidity premium, extra yield demanded for holding a longer bond. The formula which we have here is 1 plus capital R sub n, all raised to the power n equals 1 plus R sub n sub 1 times 1 plus R sub 2 and so on, so up to 1 plus R sub n. What it says, investing once for n bonds must pay the same as rolling one period deposit n times in a row. R sub n is the annual spot rate today for a loan of n periods, n is the number of periods, R1 is the one period rate today, R2 through Rn are the one period rates that apply in each later period. Both sides are growth factors, so the left side compounds one time n times, one rate n times, and the right side chain n different rates. One clarification here is that R2 through Rn are not observable today. Today, they're expected rates and should be written as ERT and ERN are replaced by forward rates, right? And the slide also mentions your kind of also states PEH and then adds a PH is pure expectation hypothesis and then adds a liquidity premium section 2. Those two do not hold at the same time. PEH requires zero premium as the premium exists. The theory is the liquidity preference theory, right? Two ideas that get confused always, pure expectation hypothesis, which means long rates is equal to average of your expected short rates, forward rate is equal to expected future spot rates, term premium is zero. Liquidity preference hypothesis, long rate is equal to average of expected short rate plus the premium. Forward rate is equal to expected future spot rate plus the premium. Term premium is positive and rises maturity. The one difference that matters here is that whether the term premium is zero or not. Where it is used, the chaining rule is the basis of bootstrapping a spot curve from market instruments and of extracting forward rate for pricing at parallel swaps. Then we go into next one, which is yield curve determinants, market forces and policy, supply demand dynamics, central bank policy. So beyond expectation and risk premium, the yield curve is also shaped by market structure and monetary policy decision. Supply and demand imbalances, according to market segmentation theory and preferential habitat theory, investors often specialize in basic maturity ranges. Pension funds prefer long-term bonds, banks prefer short-term securities. Government issuance may concentrate at certain maturity. Such supply-demand imbalance can cause distortion in yields across different segments of curve. Central bank policy stance. Central bank influence the yield curve through monetary policy tools such as your policy, interest rate adjustment, quantitative easing, open market operation. For example, aggressive rate cuts typically reduce short-term yields more than the long-term yields, resulting in a steeper yield curve, right? So again, terms defined here, we are looking at Market segmentation theory, each maturity bucket is its own market set by its own supply and demand. Preferred habitat theory, uh, investors have a favorite maturity bucket, but will leave it for enough extra yield. Quantitative easing, the central bank buys bond outright to push yields down, usually at longer maturity. Open market operation, routine buying and selling of short government paper to steer the policy rate. Cheaper yield curve, the gap between long and short yields are widened. So the two more drivers which are added on to the two on slide number two, right, which is previous slide. Driver three, supply and demand across maturity bucket. Driver four is the central bank policy. An example given are pension funds at the long end, banks at the short end, and government issuance concentrated the chosen maturities. Each of these creates a local supply demand imbalance, which shows up as a king or a rich or a cheap point on the curve. So the last line states the rate cuts lower short yields more than long yield, which steepens the curve. That is correct. Now, the policy rate anchors the front end directly, while the long end is driven by inflation and growth expectation. Two ideas again that are confused majorly by students is market segmentation and preferred habitat. The market segmentation means buckets are fully separate. Yields in one bucket say nothing about the next. No substitution at any yield. Preferred habitat says buckets are linked. Yield gaps get arbitrage if large enough, right? And substitution happens above a threshold yield pickup. The one difference that matters here is whether the investor will switch maturity for enough compensation or not. Where it is used, segmentation and habitat effects are the reason a fitted curve model leaves residual at physical maturities and relative value days trade those residuals. Okay. Then we get into the next part, which is normal yield curve, which is definition and visual pattern. Normal yield curve, also called as upward sloping yield curve, occurs when long-term interest rates are higher than the short-term interest rate. This implies that investors require higher yields to lend money for longer maturities. Typical visual pattern, short maturity yield less than long maturity yield. The curve rises gradually as maturity increases. Example, maturity yield 2 year, 10 year, 3 year, 4.5 years. Such a pattern indicates that investors expect higher interest rate in the future and demand compensation for holding long-term bonds. Okay. So again, terms defined here, normal yield curve, also called upward sloping. Longer term yield sits above the short term yield. The relationship is the short term yield is less than your longer term yield. And the relationship is the test for the shape. Compare any short point on the curve with any longer point. If the longer one is higher across the whole curve, the curve is normal. Table is given, two rows, left column is maturity, right column is yield. The 2 years sits at 3% and 10 year at 4.5%. The one thing it shows is the 10 year is 1.5 percentage points above the 2 year. So the curve rises maturity. One clarification I'll add here is that the closing line says an upward slope indicates investors expect higher rates in the future. An upward slope alone does not prove that. Positive term premium introduces or produces an upward slope even when the expected path of short rate is flat. Expectation of premium cannot be separated from the yield curve by itself. A term structure model is needed to split them. When it is used, a normal curve gives positive carry and positive roll down and long position. That is a standard set up for a levered carry trade in fixed income, right? So that's great. Then we get into the next part, which is why the yield curve upward sloping, expectation and liquidity premium. Two main economic forces explain the upward slope of the yield curve. Expectation of rising short-term rates. If investors anticipate stronger economic growth, they may expect higher inflation, higher future central bank policy rates. Under the pure expectation hypothesis, long-term yields incorporate expected future short-term interest rates. Liquidity term premium, investor demand extra compensation for holding long-term bonds due to inflation uncertainty, higher duration and price stability. Lower liquidity compared to short-term security. This additional compensation is known as the term premium, which pushes long-term yields higher. Right. So again, the two forces from slide number two, right? Restated across of the upward slope. Part A is expectation of rising short rate. Part B is the premium. Term defined here, term premium, the extra yield on a long bond over the average expected short rate for the same horizon. Duration, the sensitivity of bond price to a change in yield measured in years. Part A links growth to rate. Stronger growth raises expected inflation, which raises expected policy rate, which lifts your long yield. Part B lists three sources of the premium: inflation uncertainty, higher duration price volatility, and weaker liquidity in long bonds. Clarification which I would like to add here is the presentation calls the same quantity, liquidity premium, slide 2, and term premium here. Standard usage kind of separates them. See, the term premium is kind of compensation for interest rate risk over the holding period. Liquidity premium is compensation for a wider bid offer and thinner trading. The term premium is the larger of the two in government bond markets. And where it is used, term premium estimates from models such as your ACM or your Kim right are used to judge whether long bonds are cheap or rich against the expected policy path. Then we get into the next part, economic interpretation of a normal yield curve. Macroeconomic meaning and market implication. Normal yield curve is often interpreted as a sign of healthy and expanding economy. Economic interpretation, economic growth is strengthening, inflation expectation remains stable, monetary policy is relatively accommodative, investor confidence and risk appetite is high. Market implications, long-term borrowing becomes more expensive than short-term borrowing, bond portfolio face greater duration risk, the forward curve generally slopes upward. Investor may prefer short duration securities during rising rate environment. For those reasons, the normal yield curve is often referred to as a healthy economic curve, right? So again, this loss exposure from holding long duration bonds and yield rise. Forward curve is the curve of interest rate that applies to lending starting at a future date. Uh, Again, four macro readings of a normal curve are given here for market consequences, and a healthy economic curve is being discussed. The macro readings are growth strengthening, stable inflation expectation, accommodative policy, and high risk appetite. The market consequences are that long borrowing cost more than short borrowing, bond portfolio carry more duration rates, the forward curve kind of slopes up. Investor may shorten duration when rates are rising, right? One thing I'd like to add here is the forward curve sitting above the spot curve is the mechanical result of an upward sloping spot curve, not a separate market view. It is pure arithmetic, not a forecast, where it is used the duration risk is the first order term in bond risk management. Portfolio duration is the main lever for positioning against the directional rate view. Then we look at the inverted yield curve, which is definition and visual structure concept. Inverted yield curve occurs when the long-term interest rates fall below short-term rate. This means investors receive lower yield for lending money over longer horizon. Visual pattern, short-term yield greater than long-term yield, the curve slopes downward, the maturity increases. Example is given, maturity and the yield 2-year 5.2, 10-year 3.9. Such a structure often reflects market pessimism about your future economic condition, right? So again, the idea here is that inverted yield curve has been discussed here. The curve slopes down as maturity rises, lenders receive less for lending. Longer table is given. Curves are rarely inverted because every maturity curves are rarely inverted across every maturity pair. That is one thing to remember here. Partial inversion is normal when the 2S and 10S spread is negative, while the 10S 30S spread can be still positive, right? So the shape should be stated with the specific pair of maturity use, not a generic view, right? Then we go into why does your yield curve inversion occur, key economic drivers, what is market expectation of recession, investor may anticipate slower economic growth, falling inflation, future central bank cuts, this pushes investors towards longer maturity. Flight to safety, during periods of uncertainty, investors shift funds from long-term government bonds, high demand raises bond price and lowers long-term yield. Your tighter monetary policy, central bank may aggressively raise short-term policy rates to control inflation. Short-term yields rise sharply, long-term yields remain lower. This combination forces an inverted yield curve. And this happened in 2022 when the federal bank raised rates, right? So again, flight to safety is given here, a shift of money into government bond in stress, as it is explained, right? You know, market expectation of recession explains the long end expected slower growth, falling inflation, future rate cuts, pulling long yields down. B also works on the long end. Buying pushes bond price up and bond prices and yields move in opposite directions, so yields fall. C works on the short end. The central bank raises the policy rate, which tracks the front of the curve up. So inversion has two mechanical roots, right? The short end rises and the long end fails are both, right? So two ideas that get confused is there's something called bear flattening and bull flattening, right? So bear flattening is the short yields rise fast and driven by the tightening policy and the rate level rise overall. Bull flattening is long yields fall fast, right? So bear flattening is short yields rising fast. Bull flattening is your long yield fall fast, driven by growth, fear, and safety in the bull flattening. Rates level fall overall, right? The one difference that matters here is the whole level of rates move up or down while the gap narrows. Where it is used, curved rates are built as spread position, long maturity, and short another size to the position in neutral to the parallel mode. Then we get into the next one, which is economic interpretation of an inverted curve, macroeconomic signals and market implication, economic interpretation. Historically, inverted yield curve has one of the most reliable predictions of recessions. In the US, every recession across the 1960s has been predicted by yield curve inversion. Typical signals: rising economic uncertainty, tight credit conditions, expectation of future interest rate cuts, possible deflationary pressures, market implication, short-term borrowing costs rise sharply, corporate financing becomes more expensive, long-term bonds may generate capital gains, and forward interest rate curves become downward sloping, right? So the signals are rising uncertainty, tight credit, expected rate cuts, possible deflation. The implication are that short-term borrowing cost will jump. Corporate funding will get expensive. Long bonds may deliver capital gain. The forward curves are downward sloping. But the point which to note here is that the recession recorded has exception and long lags also. The 1966 US inversion was not followed by a recession. Right, the gap between the inversion and recession start has run from about 6 to 24 months, which limits its useful timing. 2022-24 US inversion was the longest on record and was not followed by a dated recession while it lasted. Right, inversion is a signal, not with a wide error band, not a mechanism. Another clarification here is long bonds deliver capital gains only if long yields fall further from here. Inverted curve on its own gives negative carry on long duration position because the funding rate is above the bond yield. The rate is used, negative carry is the running cost of holding duration in an inverted curve. It is the number that decides whether long duration resistant trade is worth holding or not. Then we get into slide number 10, graphical example, inverted yield curve shape during economic slowdown. The graph is given, the downward sloping curve illustrates the short-term yields exceeding long-term yield. This configuration often appears before economic slowdown or recession, right? So what is on slide? One line chart with no numbers. If you look at diagram, the horizontal axis is maturity rising to the right. The vertical axis is yield rising upward. A short line starts high on the left, labeled short term, is false that is in the right. Ending lower, labeled long term. The one thing that it shows is yield falls as maturity increases. The caption repeats that short term yield exceeds long term yield, and that this shape often appears before slowdown. One clarification here is the picture draws inversion as a straight downward line. Real inverted curves are usually not straight. Please understand that they often fall to a trough around and then rise again at the long end. So the term premium is still positive out there. Then we get into slide number 11, flat yield curve, definition of visual pattern, concept. A flat yield curve occurs when short and long-term interest rates are approximately equal. This means the return for lending money is nearly the same across different maturity. Visual pattern, short-term yield, almost equal to long-term yield. The yield curve appear almost horizontal across maturity. Example, maturity, 2-year, 10-year, yield 4 and 4.5. This pattern indicates that investor expects little difference between current and future interest rate, right? So very, very interesting part. The definition is given. The defining relation is given. A two-point example is given. Flat yield curve, short-term and long-term yields are close to equal. Short-term yield is approximately equal to long-term yield. The approximation sign matters. A flat curve is never expectedly flat, right? It's a curve where the gap is small enough to be treated as zero for positioning purposes. Left column maturity, right column yield, the 2-year is 4% and the 10-year is 4.05%. The one thing it shows is a gap of 5 basis points across 8 years of maturity, which is close to zero. Terms defined here, basis point, 1/100th of 1%, so 0.01%, right? Flat has no fixed threshold. Please understand that. Desk usually treat a 2S, 10S, paired roughly plus minus 25 bips as flat. The number depends on the market and the volatility regime. The slide closing line says the flat curve means investors expect little difference between current and future rate. That skips the premium part, right? A flat curve with a positive term premium implies expected short rates are falling or staying still, right? So when it is used, the flat curve removes roll down feature, roll down return. A carry trade that rely on rolling down the curve stop kind of paying, right? Then we get into next part. Why do yield curves kind of flatten? Transition phases in the business cycle. Yield curves typically flatten during economic transition period. A transition from normal to inverted, market being expecting slow economic growth, long-term yield falls while short-term rates remain relatively high. Transition from inverted to normal during early economic recovery, central banks start cutting rates. Long-term yield stabilize, this typically produces a flat yield curve. Mixed macroeconomic signals, inflation and growth outlooks are uncertain. Markets cannot determine the long-term direction of interest rate. Right? So what is on the slide? Basically, 3 routes to a flat curve. A is the move from normal towards inverted. B is the move from inverted back towards normal. C is the mixed macro signal. It works because long yield falls on slower growth expectation, while short rate stays high. The curve passes to flat on the way down. P works because central bank cuts, which pulls the short end down, while long yield holds steady. The curve passes through flat on the way up. See, different here. Flatness is not a transition. It is the market fading to form a direction view on inflation and growth. Technical clarification here is the slide labels B as early economic recovery. Central banks usually begin cutting during or just before the downturn, not during recovery. The consequence is normally cuts, or the sequence is normally cuts first, then trough, then recovery. The mechanism described is correct. The timing label is a little off, right? So 2 ideas that is confused: flattening and your flat. Flattening means a change in the curve. Measure a spread narrowing over time, describes direction of travel. Flat means the state of the curve. Measure a spread near zero today, describes current level. The one difference that matter here is flattening the movement, flat is the level. Where it is used, basically a flattened spread trade that profits when the gap narrows. Three routes above are the three separate reasons to put one on, right? Then we get into slide number 13, which is economic interpretation of a flat yield curve, macroeconomic meaning, and the market implication. Economic interpretation of flat yield curve often signals uncertainty about the future direction of the economy. Typical indicators: market uncertainty regarding economic growth, transition phase in business cycle, monetary policy approaching a turning point. Investors unsure whether expansion or recession lies ahead. Market implication: term premium becomes very low. Interest rate hedging becomes very difficult. Long-term borrowing becomes relatively expensive. Inexpensive. Forward curves become nearly flat. So, what is on the slide? Four typical indicators, four market implications. The indicators are growth, uncertainty, a business cycle transition, policy near a turning point, investor unsure about expansion and recession. The implications are a very low term premium, harder interest rate hedging, cheap long-term borrowing in relative terms, and a nearly flat forward curve. Term defines here turning point, the moment the policy rates stop rising and starts falling or the reverse. A technical clarification I'll add here: if the slide says hedging becomes more difficult, the mechanical fact is narrower. A flat curve makes the choice of hedging maturity less costly because yields are similar across the curve. What gets harder is the directional fall. Since a flat curve gives no signal about which ways rates go next, hedge construction itself is kind of unchanged. One other clarification here is long-term borrowing becomes relatively inexpensive is correct only in relative terms. The long rate is not lower in absolute terms. Okay, and it is simply no higher than the short rate where it is used. The flat curve means the forward rate equals the current spot rate. Any instrument price of forward, such as swap or FRA, then price of today's level with no expected rate. Okay, that is what we need to understand. Then we go to slide number 14, which is graphical example, flat yield curve during economic uncertainty, yield versus maturity, short term versus long term. The nearly horizontal yield curve indicates that the market expects little change in future interest rates, such as configuration often appears during periods of economic transition or uncertainty. So what is on the slide? Basically, one line chart with no numbers. Horizontal axis maturity rising to the right, the vertical axis yield rising upward. A single nearly horizontal line runs to left to the right. Label short term at left and left end, and the long term at right end. The other thing it shows yield barely changes, the maturity increases. The caption states that the horizontal curve means the market expects little change in the future rate and that disappear during transition or uncertainty. The clarification I'll add here is the drawn line has a very kind of a slight upward tilt, right? Read it as a flat. The tilt is a drawing artifact, not a feature of the shape. Then we get into slide number 15, right, which is about humped bell-shaped yield curve, definition, visual structure. A humped yield curve, also called the bell-shaped or butterfly curve, initially rises with maturity, reaches the peak at medium maturity, then declines for longer maturity. Visual pattern: short-term yield less than mid-term yield, which is greater than long-term yield. The highest yield occurs in intermediate maturity. The table is given: 2 years, 7 years, 30 years, 2.8, 4.3, which is a peak, 3.7. This shape reflects differing expectation across short, medium, and long horizon, right? So quite simple to understand, right? So the two inequalities together locate a maximum somewhere in the middle of the curve. Neither inequality alone identifies a hump. One clarification I'll add here is the chain inequality as written is not very a good way of notation, right? It should be split into two statements: mid-term yield exceeds short-term yield, and mid-term yield exceeds long-term yield. Written as a change, it can be misread as short-term being compared with long-term, which is with the hump condition does not constrain. Another point here is butterfly curve is not standard for the shape. A butterfly is a trait, long or short, the middle maturity against the two wings. The shape is called hump or bell shape. Where it is used, the hump is the shape a butterfly trade is built around by the wings and sell the belly if the hump is expected to flatten. Then we have why does the hump yield curve occur, right? Now the explanation, key drivers of the bell-shaped curve. Several macroeconomic and market forces can produce a hump in the yield curve. Is the midterm uncertainty. Markets may be uncertain about economic condition in 3 to 7 year horizon, causing investor demand higher yield in the segment. B, the supply-demand imbalances. Heavy government issuance and midterm maturity, strong demand for long-term bonds from pension funds and insurance companies. And C, the interest rate expectation. Market may expect rising short-term interest rate, declining short long-term interest rate. This combination pushes midterm yield upward related to other side. So, what's on the slide? Basically, three drivers of the hump. A is the midterm uncertainty. B is the supply and demand imbalance. C is the interest rate expectation. Term defined here are belly, which is the middle section of the curve, roughly the 3 year to 10 year area. Think the short end and the long end, the two maturities either side of the belly. A places the uncertainty in the 3 to 7 year window, which lifts yield in that segment. B has two parts: heavy government issuance in the belly, which is belly yields up because the more supply needs a higher yield to year. Strong pension and insurance demand at the long end, which is long yield down because more buying raises prices and lower yield. Both effects deepen the hump from opposite sides. C combines rising short rates with falling long rates. The crossing point sits in the belly, which is where the peak forms. Uh, Clarification I'll add here is pension and insurance demand is driven by liability matching. Their liabilities are long dated, so that buy long dated assets to match duration regardless of the yield level. That's a structural bid, not a view on rates, right? So what it is used, issuance calendars are published in advance, concentration one maturity bucket is tradable rate agreement, right? Which we need to understand. Then we go into slide number 17, right? Which is nothing but economic interpretation of a hump curve, macroeconomic signals, and the market implication. Economic interpretation, a hump yield curve often appears during late stage of economic expansion. Typical signal, elevated inflation risk in the medium term, expectation of slower term economic growth, monetary policy becoming increasingly restrictive, investor preferring very short or long maturities, very long maturity. Market implication, attractive opportunities for butterfly trading strategy, which we discussed, complex duration and convexity hedging, midterm forward rates becoming unusually high, right? So again, four typical signals as they were with the other ones, and three market implications for the hump shape. The three signals are elevated medium-term inflation risk, expected slower long-run growth, increasingly restrictive policy, and investor preferring the very short or very long end. The implication of butterfly trading opportunities, complex duration, and complexity hedging, and unusually high midterm forward rate. Right, the term defined here: butterfly trade, a three-leg position, one leg in the belly and two in the wings. Size of the position is neutral to parallel and slope moves. Convexity, the second order sensitivity of a bond price to yield, measuring how duration itself changes as yield changes. And technical clarification, the late stages of economic expansion claim is one common index, not the only one. Humps also form from pure supply effects at a single maturity and from central bank purchase program that target one bucket. The shape does not carry a single macro meaning where it is used. Hedging a hump curve requires more than one duration bucket. A single duration hedge leaves the position exposed to hump moving up or down independently of that level, right? Then we go to slide number 18, which is graphical example of your hump yield curve, L-shaped term structure. We have yield and maturity, and we have the short, long, and peak. The curve rises for the short maturity, peaks at the intermediate maturity, and declines for longer horizon. This structure reflects midterm interest rate risk and changing macroeconomic expectation, right? So we have discussed this, right? So the diagram, the horizontal axis is maturity, rising to the right. The vertical axis is yield, rising upward. The short line starts low at the left, labeled short, rises to the maximum labeled peak, then falls away to the right to the point labeled long. The one thing it shows, the highest yield sits in the middle of the maturity range, not at either end. The caption repeats the risk or the rise and the peak decline pattern and attributes it to midterm rate risk and shifting macro expectation. Note that the long endpoint sits above the short endpoint on this drawing. That is a common sense. The hump condition does not require it. Okay, then we go into slide number 19, right? Mathematical interpretation of the curve slope, slope of the yield curve. Slope of the yield curve measures how interest rate changes maturity mathematically, which is given by this equation, right? Slope equals the partial derivative of R of capital T with respect to capital T, where R T is the yield to maturity at T, interpretation, positive slope, normal yield curve, negative slope, inverted yield curve, and the graph given here, right? So basically, what it says, the slope is the rate at which the yield changes, the maturity changes. RT is the yield on a zero coupon bond maturing in T years, T is the maturity in years. The symbol given partial marks the partial derivative, which measures the change in one variable while others are held fixed. The result is measured in yields units per years of maturity, right? That we need to understand. And again, the two readings given here are very, very important to understand. Positive slope means a normal curve, negative slope means an inverted curve. Technical clarification which I'll add here is with only t as an argument, it's an ordinary derivative, dr by dt, not a partial derivative. The partial derivative notation is correct only if the yield is written as function of both standard time and maturity, which is RTT, right? So partial derivative when we have two variables, right? Which the side does not do, right? So normal derivative will also work here. The slope, the local quantity, it has different value than the maturity. The curve can have positive slope at the front and negative slope at the back. Following the whole curve, kind of normal or inverted from one derivative is only valid when the sign holds across the whole curve, right? In practice, let's use a discrete proxy, the 2S tennis spread, and they take it like S 210, right? They take it, which is R rate at 10 and rate minus 2, right? S sub T comma 10 equals R of 10 minus R of 2. This is the yield of the 10-year minus the yield of 2-year, put it in basis point. This is a market standard slope measure because it uses two traded points instead of flatted derivative. Or fitted derivative, right? If you look at the chart, the horizontal axis maturity running from about -1 to 11 years. The vertical axis is yield running from 2 to 4. The two straight lines are drawn. The blue line labeled normal curve start at 2 at maturity 0 and rises to about 3.5 at maturity 10. So that label line inverted curve starts at 4 at maturity 0 and falls about 2.5 maturity 10. The cross near maturity 6.7, the one thing it shows a positive slope rises left to right and a negative slope falls left to right. For clarification, I'll add here the horizontal axis extend to negative maturity. Negative maturity has no meaning. The plotted region left of zero should ignore. Where it is used, slope is the second factor in principal component analysis of yield curve moves after level. It typically explains 10% of daily curve variance against roughly 80% of level, right? We need to understand. Then we go to slide number 20, which is mathematical interpretation, curvature of the yield curve. The curvature of the yield curve describes how the slope itself changes across maturity. Mathematically, curvature is given. Curvature equals the second partial derivative of r of capital T with respect to capital T, but it says your curvature equals the second partial derivative of r of capital T with respect to capital T. And curvature measures how far the slope itself is changing as maturity increases. So RT is again the yield and maturity at T, the superscript 2 in your partial square, right? This one, right? Marks the second derivative, meaning the derivative is taken twice. The second derivative is slope of the slope. The two readings given are positive curvature means a hump curve, near zero curvature means a flat curve. I'll add a clarification here just to understand that the first reading has if it's signed backwards, a hump is a local maximum. The local maximum, the second derivative is negative, not positive. Positive second derivative means the curve is convex upward, which is a trough or U shape, not a hump. The correct statement is negative curvature, right? It's a negative curvature, right? Negative curvature implies a hump curve. Positive curvature implies a U-shaped or dipped curve. Please understand that. Second clarification I'll add here is the market convention for curvature is the butterfly spread, and it uses the opposite sign convention to the calculus definition. The standard 2s, 5s, 10s butterfly is given as B is equal to 2R5 minus R2 minus R10. Right, B equals 2 times of R of 5 minus R of 2 minus R of 10. This measure how far the 5 years sits above the straight line during the 2-year and the 10-year. Positive B means the belly is rich and relative to moving, which is a hump, right? Note that this is positive for a hump while the second derivative is negative for the same shape. The two conventions do not agree in sign, the sign mixes them. The chart which we need to understand is the horizontal axis maturity running 0 to 10, the vertical axis the yield running 2 to 3. The purple line labeled hump curve starts at 2, rises to a peak about 2.7 in maturity 7, 5, then fall back to 2. The orange line labeled flat curve is horizontal 3 across the whole range. The one thing it shows is the hump curve has a single interior maximum, flat curve has none. Clarification which I'll add here, the flat line sits at 3 and the hump curve peak at a curve peaks at 2.7, so the two never crosses. That vertical separation is arbitrary and carries no meaning. Only the shape should be completed, not the level. And where it is used, please understand curvature is the third principal component of curve moves. After level and slope, it typically explains a few percent of daily variance. Butterfly traits are the direct expression of that curvature view. Then we go to slide number 21, which is yield curve shape versus forward curve, comparison of yield curves and forward curves. Forward curves reveal market expectation of future short-term interest rates more clearly than your yield curve. Relationship between yield curve shapes and forward curves are given. Table is given. Forward curves are central to modern term structures such as your HJM, Heat-Gerometer, labor market model, and interest rate derivative pricing, right? So we need to understand this table, right? So what's on the slide? A 4-row table mapping each yield curve to the corresponding forward curve behavior plus 3 application of forward curves. Terms defined here: forward rate, the interest rate agreed today for a loan that starts at the future date and ends at a later date. Forward curve is those forward rate plotted against the start date. HGM, Heat-Gerometer, a term structure model that specifies the dynamics of the whole forward curve directly. LMM is the labor market model, a model that specifies the dynamics of a set of discrete forward rate directly. Table which are given 3 curves, yield curve shapes, forward curve behavior, interpretation, 4 rows, normal maps to upward sloping forward, inverted maps to downward sloping forward, hump maps to forward that peak early then decline, flat maps to nearly constant forward. The one thing it shows is the forward curve kind of exaggerates the shape already present in the spot curve. The relationship between spot and forward is arithmetic. For a spot curve RT, the instantaneous forward rate is, the formula is not given, but I'll give it to you. FT is equal to RT plus T partial RT partial T. Okay, so F of capital T equals R of capital T plus capital T times the partial derivative of R of capital T with respect to capital T. What it says, the forward rate maturity T equals the spot rate maturity plus maturity multiplied by the slope of the spot curve FT. FT, the instantaneous forward rate for lending starting at time T. The second term is the correction that makes the spot rate the average of all forward up to T. The slope is positive, the forward sits above the spot. When the slope is negative, the forward sits below. Clarification here, the formula is missing from the deck. And without it, the table on the slide looks like an empirical claim. It is not. Every row follows directly from the sign of partial R by partial T in the equation above. The forward curve is derived from the spot curve, not observed separately. Another clarification I'll add here, the slide says forward reveals expectation more clearly than yield. Forward equals expected future spot rate only under the pure expectation hypothesis, with the slide number 5 also contradicted by introducing a term premium. With a positive premium, forward set above expected future, your spot rate will overstate your expected tightening. Another clarification I'll add here is LIBOR was discontinued for most currencies by mid-2023. The model framework survived and is applied to term SOFR, SOFR, term ESTR, and similar rates. Now, it is now often called the market model for the forward market model. Where it is used, HGM and LMM are the standard framework of pricing caps, floors, swaps, and Bermuda and callables. Both take today's forward curve as the starting input and model how it moves from there. Okay. Then we go into next part, which is practice problems. Now, identifying the curve shape. Problem number 1, identify the yield curve shape. Maturity is given, rates are given, solution is given, conclusion is given. Go back and do it, guys. Everything has been explained. Similarly, problem number 2, again, observe rates are given. You have to identify the curve type, solution and conclusion are given, historical data is given. Same thing here, practice problem number 3, identifying a flat curve. The rates are given, spot rates are given across maturity, solution, conclusion, and analysis is given. Then problem number 4, humped curve recognition. Again, spot rates are given, solution, conclusion, result is given. Then you go to practice problem number 5. Again, slope calculation, yields are given, slope calculation is given, interpretation is given, market temperature is interpreted as signal of expected economic growth. That final analysis is given. And finally, in practice problem number 6, curvature calculation is also given, observed yield, analysis, interpretation, result, and what is it that also is explained, right? So that completes our this lesson entirely, right? Practice questions are for you to practice, guys. Please go back and do it because that's how the active learning happens, right? You cannot, you should not just listen to it, right? You will go back and solve on your own, right? So notes are given, explanation are given, conclusions are given, results are given, analysis is given, questions are given, data is given, everything is given, right? You just have to sit with it and think about it and analyze and solve, right? Summary of this lesson, the slide put together, slide 2 and 3 set out 4 forces that shape the curve: expected future short rate, risk premium, supply and demand of maturity buckets, and central bank policy. Then slide number 4 to 18 apply these forces to the 4 standard shapes and a repeating pattern of definition, cause, economic reading, and picture that you have to understand and read and analyze and note down. Normal on slide number 4 to 6, inverted on 7 to 10, flat on 11 to 14, and humped on 15 to 18. Slide number 19-20 replace the verbal description with 2 derivatives. Slope separates normal from inverted, curvature separate flat from humped. Slide number 21 was showing that the forward curve is derived from the spot curve. So each spot shapes maps to one forward shape by arithmetic, not by separate market view. And slide number 22 to 27, which are the latest one, right? Test your recognition of all 4 shapes from raw spot data, then put numbers on slope and curvature, right? 5 common mistakes which happen here, which we will not repeat, right? Reading an upward slope and an expectation of rising rates. Please don't do that. A positive term premium produces an upward slope with a flat expected rate path. Expectation of premium cannot be separated from the yield curve alone. Then getting the curvature sign wrong, that's also a big error. A hump is a local maximum, so the second derivative is a negative there. The deck state positive on slide 20, which I have corrected. The market butterfly measure is positive for a hump, which is the opposite convention. Always state which measure is being used. Third error is confusing spread with slope. The 2S 10S spread of 180 bips on slide 26 is a difference. The slope of 22.5 bips per year is that difference divided by the 8-year maturity gap. Both are used and both are not the same number. Another mistake is classifying the whole curve from one maturity pair. Slope changes at every point. A curve can be inverted in 2S 10S and still upward sloping in 10S 30S. So keep that in mind. State the pair used. Last but not the least, stating inversion as a recession forecast with a known date. The historical lead time has run from roughly 6 to 24 months, and the signal has failed before. 22 to 2024, 2022 to 2024, it failed again. It's a wide error band indicator, not a mechanism, right? So please understand all this. Go back and revise this. Do at least twice. Revise at least twice. Go back and solve the question. Understand the logic. Understand the analysis. Understand the practical use and understand the formulas and solve the question on your own, right? That's it, guys. That's it from my side. Go back and revise it, and once you've done it, I think you'll be totally fine, right? And with that, we close our lesson number 3 of yield curve modeling, chapter number 1. And I'll see you in the next lesson, which is lesson number 4, or chapter number 1 of the yield curve modeling. Okay, that's it, guys. That's it from my side. I'll see you next week. Thank you.